Hi guys, it's Selma with EXP, and today I'm here with my friend and mortgage partner Norbert with LeaderOne Financial, and we're here at the Baguette Cafe in Henderson, Las Vegas. Henderson?
That's right, Henderson, Nevada.
Yes, Nevada. And we are gonna have a conversation with you guys about what's happening in this crazy market. So I wanted to bring Norbert today in this conversation so we can have a perspective from a professional that works in the mortgage industry. So Norbert, a lot of my clients are very concerned with what's happening in the market right now because, you know, the prices are going up. Many people are talking about if there's gonna be a bubble, if everything is just gonna burst and crash. And the major concern is the interest rates that started going up like crazy in the last few months. So can you help us? We want to find out how we can actually help these clients and how they can, if it's a good time to buy now or if they should just wait for the rates to drop.
Yeah, good question actually, Selma. You know, prices have been going up for years in Las Vegas and Henderson in the Valley. And that's been a concern for many people. And hey, when is it going to stop? Will it plateau out? Will it come down? Like, no one really knows. Everyone has an opinion. Values in real estate is very cyclical. So yes, prices do come down, but it's very difficult to predict when it will start coming down. And that's anyone's guess. And it is truly a guess. So that part, you know, there's a little bit of an unknown to, but I can tell you this is interest rates have been on the march up. And for a long time, ever since 2020, when this whole pandemic started, rates went down a lot, right? We were in the twos. We were in the mid twos, the high twos, in the threes. And over the past 3 to 4 months, right now it's March of 2022, ever since December to now, rates have gone up like a full 1.5 points. Wow. And we're now in the low to mid fours, depending on when these guys are watching the video. And you know, that definitely, historically speaking, is still very, very low. But it's sometimes shocking because we were so used to the twos and the threes. Now that we're in the fours, people are like, whoa, that's way higher than I thought. So, you know, historically looking back on it, in the fours is still an excellent rate.
It's still not bad.
Not bad at all.
And comparing it to the national average too, right?
Yeah, so I mean, going back before 2020, you know, we were in the threes and the fours. And we got spoiled a little bit, but you know, things have been going up and maybe they will continue to go up. So if you're not sure about values, one thing we're sure of is that interest rates are going up, and it's better to get in sooner rather than later so you can lock in a really good low rate as opposed to waiting and letting this thing go up another quarter, a half a point, or maybe even a full point.
So let's take can you give us like an example? For example, I had clients, they were getting like a rate in the low threes in November, December, and they didn't get a loan. So now they're ready and they want to buy, but they're like, oh, Selma, but the rates are so high. They're like over 4%. Can we even afford? So like, what is like let's say there's like 1% increase in the rate. What does that make a difference in their buying power?
Yep. Yeah, well, first of all, it's not too late. So just because rates have gone up, you know, you should still buy sooner rather than later. Like, waiting can cost you. And here's an example. Let's just say the person that we're dealing with, our client, makes $72,000 a year, which is about $6,000 a month. And they need a loan, right? They're going to finance it. And we're going to do, let's say, a 30-year conforming fixed loan. With 20% down, which is normal. A lot of people do that. By the way, you can put a lot less down. But for this example, let's just say it's 20% down.
Keep it simple.
The way that lenders measure how much payment you qualify for is the debt to income ratio calculation. So it's simple. It's your debt, which includes your housing payment, divided into your gross income. And typically, you cannot exceed 40 to 45% of your income. So for someone that makes $6,000 a month, that means they can spend on a housing payment about $2,700.
Okay.
$2,700. But that has to include principal, interest, taxes, insurance, mortgage insurance, HOA, if there's SID, LID. So it's all together cannot exceed $2,700. So let's say in late December of 2021, the rates were, let's say 3%, 3.25%, right?
Okay.
That borrower, if they can afford $2,700, that equals about $640,000 in sales price.
Okay.
With 20% down, that means they're financing $512,000 loan amount. That same borrower today, if rates go up a quarter, let's say they're at 4.25% instead of 3.25%, now that person with the same $2,700 payment, because their income's the same, can now only afford a sales price of $578,000.
Oh, wow.
With 20% down, that makes their loan amount $462,400. So 1% in this example of a person making $6,000 a month, $72,000 a year, 1% increase in rate lowers their purchasing power by $62,000.
Wow, that's a lot of money, especially here in Las Vegas. That's a big difference where with this house you might fall in love with and this house you might just settle down for.
That's right. Yeah, $62,000 is a big difference between, loving a house and just having to settle for it, like you just said. So yeah, the more rates go up, obviously the more it eats into your purchasing power unless your income's going up. So definitely time is of the essence. You want to get in, lock in your interest rate. By the way, in order to lock the rate, you have to have a specific property address.
Okay.
So once you get in the contract, then that very next day or the same day, we can lock in the interest rate to prevent it from going higher so that your rate and your payment is locked in.
Well, that's good news. At least once we find the property, we can lock in that rate so you don't lose it until you close escrow, and then you have that fixed rate for the life of the loan.
That's right. And that's one of the biggest benefits, right, from buying a house is that we give you a fixed 30-year rate and payment. So as time goes on and you start to make more money, right, because you're advancing in your employment or you're getting raises, that mortgage payment is going to be less and less as a proportion of your income. So it becomes easier to make. And that's an advantage of buying, because if you're renting, the landlord, their goal is to get the greatest rate of return. So they're probably going to increase your payment, your rent payment, once a year at the renewal of your lease. So it's never locked in. It always keeps up with your income or inflation, as opposed to a mortgage, which stays the same. And that's a huge difference and a large advantage on a mortgage. And by the way, the discount that no one ever mentions or people fail to realize is your payment on a mortgage, a large portion of it goes towards reducing the principal. So even though you may be paying $2,000, a part of that's paying down a loan balance. That's equity in your own pocket that you're creating through amortizing the loan. So again, better than renting. The alternative's not better.
So what Norbert just said, you're building equity over time. So in case mortgage rates do go down, at that point, you can always refinance, right? And get that lower rate.
Yeah, so if you're not happy with the rate, but then we enter a period of time where rates go down, we'll end up refinancing it, lowering your payment because the rate goes down. And for those folks that have to buy with less than 20% down, they need mortgage insurance. A lot of times when we go to refinance, that equity has increased because you paid it down and maybe because the home appreciated. When we refinance it, maybe you get rid of mortgage insurance too and ditch that thing.
Wow.
So double whammy, right? Lower rate, no mortgage insurance. So there's always that option of refinancing in the future to lower the rate and your payment.
Okay.
Yeah.
That's some good news. But I also get a lot of questions from buyers. Let's say, they really want to buy now. They're ready, but the rates are high. Is there anything that they can do, or are there any strategies that our buyers can do in order to qualify for more house, even though the interest rates are high?
Yes. So if you're working with a great real estate agent like Selma and we're partnering up, there are some strategies that we can implement to fight against this increase in rate that we've seen over the last, 4, 5, 6 months. So there's two ways to gain back your purchasing power, right? Number one would be to make more money. Easier said than done. So getting a raise definitely would help, but probably not an option for most people, at least, right away. But one way to add more income to the loan application to qualify for more is to add a non-occupying co-borrower.
Okay.
So like, for example, mom or your dad we can add them to the loan application. They don't have to occupy the home. So you're still the occupant borrower. They're going to be a non-occupying co-borrower. And now we can pull in their income. Of course, we got to pull in their liabilities too. But if they make good money, decent money, and their liabilities are normal, or maybe they're lower liabilities, then by adding a co-signer or co-borrower, we can increase the payment that you qualify for, thereby, of course, translating to a higher loan amount and a higher sales price. So that would be one way to increase your purchasing power. Okay. Definitely.
What about getting a co-borrower from a boyfriend, girlfriend? Can you do that?
You can, but we have to be able to establish a long, outstanding relationship between you and that other person.
So if you live together?
Absolutely. If you live together, we can show an underwriter maybe a utility bill, like your power bill, that both of your names are on there, and you guys are making that payment together, or your driver's licenses with the same address. So we can establish that relationship that you guys live together, right?
So it can be a complete stranger?
Probably not gonna work. It's got to be a relative in most instances. So, but your example is great when you're living together, boyfriend, girlfriend, or you're engaged. We just have to show and prove that relationship. And one of the ways we can do that is a utility bill that you guys live together. Here's the proof. Or maybe you're on the same lease.
All right, that's easy. What are some other ways?
Yeah, so other strategies that we've successfully implemented with our clients in the past is lowering the debt, right? So to qualify for more, we got to maybe eliminate some debt. So paying off credit cards, paying down a car, paying down an unsecured loan, maybe selling a car, maybe sacrificing selling a car so you can purchase a home that is more meaningful, that you feel comfortable.
Get the car later, right?
Yes, do not buy a car before buying a house. Get the garage to park the car in before you get the car. So definitely paying off debt is one strategy. Putting down more money, right? The more down you put, the lower the balance. That helps with the mortgage payment being smaller. So you could qualify for more. But that's a difficult one too, because if you have a bunch of money, yeah, it's easy. But if you don't and you budgeted for 3% or 5% down, then that's all you got to work with. So maybe it's not viable.
You can get a gift from like your parents or
Very
sister or brother, or
Yeah.
Does that have to be again a relative, or?
Yes, so you can get a gift from a relative, right? It's simple. They sign a gift letter, and then we have to source where the money's coming from to make sure the donor of the gift had it in their bank account. We do that with a statement that we get from them. And then they would just wire that money directly into escrow. And that would be the down payment that you could utilize to help lower the payment. And we can do that through a gift. Great suggestion. Yeah.
So it can't be just like cash on the table?
No. There's a lot of, anti-money laundering rules that underwriters have to make sure they abide by. And sourcing cash can sometimes be very difficult. Definitely talk to your loan officer before you deposit cash. Because you want to make sure you're not depositing something that you can't use.
Yeah.
Yes.
We actually did have a mutual client where they transferred it right away. Or what happened there?
Yeah.
The gift?
Yes, so they transferred it, but it was a cash deposit, and it was a little bit difficult to sort out. We finally got through it, but it creates way more work if you do it without consulting first, because you don't want to get in a position where you put it in, it came from a source you can't use, and then you just can't use it.
Right.
So gift is another great idea to getting more money down. But if you can't do any of those, get a raise, put more money down, or pay off some debts, there are some other ways to do it, right? So another way to lower the payment is to buy down the interest rate. So if the rate's 4.25 and you're on the borderline of qualifying for a home that's much nicer, maybe look into paying points to buy down the interest rate. Instead of 4.25, maybe you buy it down to 3.75. You pay a cost up front. It's a closing cost, so you come out of pocket for that, but then you get a lower interest rate and thereby a lower payment, which again allows you to qualify for more home, right? Which is what we're trying to figure out. How do we fight to gain back our purchasing power that maybe we've lost from higher interest rate? So buying down the rate could be a viable option.
How much does it cost? Like how much can it approximately cost to buy down?
It varies depending on the rate sheet and the day that we're looking at, because there's a pricing side of the rate sheet. But a good rule of thumb, it'll cost you about 1% of the loan amount. So if you have a $300,000 loan, it's $3,000, and that will buy down your rate approximately a quarter.
Okay.
Now, that's not set in stone. That varies daily depending on the rate sheet, but to get a quarter in rate, it'll cost you about 1% of your loan amount, not the sales price. So good question. Buying down could help lower the payment. Two other really good ones, by the way, and sometimes people don't think about it. This is a little bit more outside the box, but if you put down less than 20%, you have to have mortgage insurance.
Right.
So mortgage insurance covers the lender in case the borrower defaults. It's insurance that the lender gets, but they make the borrower pay. It's not very fair, but that's how it works. So if you're putting less than 20% down, you have to have mortgage insurance. And there is a way to not have monthly mortgage insurance, and that's by just paying up front. You buy out of it. And so you'd utilize what they call a single premium paid upfront. And you pay the price, again, upfront as a closing cost, to get out of having the monthly mortgage insurance. Again, it reduces your payment, so you no longer have the monthly mortgage insurance. And as a result, now you can have more principal and interest payment, which equals a higher loan amount, which equals a higher sales price. Again, we're gaining back our purchasing power by implementing this strategy.
Okay, that's a really smart one. I didn't know that you can pay your mortgage insurance up front. So that's
one time you pay it and you never have it, even if you put less than 20% down.
That's a good one.
Another one that we could maybe utilize our strategy is some areas in Vegas, as you know, are in special improvement districts. We call those SIDs or LIDs, right?
Yeah, like Summerlin or the new northwest part of town where there's a lot of newer construction.
Yeah. The developers take out loans to develop the infrastructure, the roads, the plumbing, and everything. And those loans then get divvied up and split and assigned to each property that's in that area. And so when you buy a house in an area like that, you might have just an example, an $8,000 balance on the SID. And every 6 months you have to pay the management company who collects. They collect twice a year, every 6 months. And it may be $600 every 6 months or $700 every 6 months, maybe $200-300. But if you buy a house in an area like that, that payment, we break it into a monthly component, monthly pieces. That now has to be counted as the payment on the mortgage as a liability, which then gets counted in the debt to income ratio, which then, erodes your amount that you could spend on the balance of the loan. So to offset that, let's say your balance on that SID lid there's only like $1,500 left. You can pay the whole thing off at the time of closing. That way, we don't have to count it in your monthly payment.
Okay. So you have less debt, overall debt, and more money to work with towards your mortgage payment.
That's right. We eliminate the SID payment, and now we can count it towards the principal and interest, which is the component that is based on the loan amount. Again, recapturing our purchasing power. So there is many strategies that we can implement. Maybe we only use one. Maybe we use one or two or three in combination with one another. So even though rates have gone up, and you feel like maybe it's outside of our reach, and I really wanted to buy a house at $450, and dang it, now I can only buy $390. We can utilize some of these strategies to gain back that and still buy you the house that you love instead of
settling.
That's right. So those are just some tips that I use with our clients on a regular basis.
Okay, well, thank you so much, Norbert. I hope that some of these tips were helpful, but the best way to really see if you can implement them is call us.
That's right.
Our contact info will be below, and we'll talk to you more about mortgages in our next video.
See you guys. Thank you.